It's an election year, right? So a presidential election comes with a lot of uncertainty. It's going to be very divisive if this is like the last couple of elections that we've had. And of course, there's going to be uncertainty with the direction of where things are going to go politically. How do we need to think about this as investors who are gearing up towards or maintaining retirement? So that's going to be the first topic that we cover today, investing in election year. The second, and I'm very excited about this one, is an upcoming webinar we have that is going to educate young investors. Call it a Personal Finance 101, if you will. It's free for all. We have, I think, a large number of seats that we can accommodate virtually. It'll be through Zoom. And I'll talk about the topics that we're going to cover and some of the particulars later. And then we'll wrap up with something more towards clients, which is taxes. And we're right in the thick of tax season. When do we get our forms? What can we expect? And things like that. So let's just get right into it. I'm going to go through some facts and figures, but when we look at an election year in our investments, the first most important point I would like to make is your portfolio is not directly tied to whoever is in the White House. So whether you agree or disagree with whoever wins in November, we want to remember that our portfolios are tied up with companies and fixed income bonds. So at the end of the day, is Apple able to sell iPhones? Is Microsoft selling software? Is JP Morgan successfully lending and bringing in revenues and profits? That is of primary concern with our portfolios, and lesser extent, the person that's in the seat in the Oval Office. So let me show you a chart and give you some of the facts and figures behind what I'm saying. So first, is there a political party, Democrat or Republican, that's better for investments? So we went back to 1933, and as you can look from this chart, there's good, bad, everything in between. There's no fact pattern. It isn't a clear leader. Stocks just tend to go up over time, right? Not guaranteed, but in the past, stocks go up over time depending on a lot of factors, not necessarily who's in the Oval Office. All right, next, let's look at in an election year, so not back to 1933, but an actual election year, what typically happens with stock-based investors. So in a non-election year, on average, the market goes up. There's not really much of a slump. But in an election year, on average, the market is relatively flat leading up to the election. So around, as you can see in this chart, May, June, the market's relatively flat, and then it goes back to its growth trajectory as the election and results become a little bit more clear. One stat that I found interesting, again, going back to 1933, that post-election, for the next 12 months, on average, the stock market is up 11+%, right? Now, that doesn't mean that if a Democrat wins, the market's up, or if a Republican wins. What that means is once the election is decided, we can go back to living our lives, and companies are not in this turmoil or news cycle of this president versus that president and so forth. This next chart shows us what investors typically do, as shown by fund flows, in a election year. As you can see, the year leading up to an election, most fund flows, most investors are putting more and more money into cash. Perhaps the thinking is, I'm going to wait and see what happens after the election, and then I'll put my investments back to work. So let me show you how the math works, again, going back to 1933, and how that actually played out. So of the last 23 election cycles going back to the 30s, we presented 3 back-tested strategies. So as we look back over the past 23 elections we've had in the country and look at the stock performance, there might be 3 different ways to look at it as an investor. The first one says, I'm putting my money in the beginning of an election year, and I'm not concerned about the outcome. Companies remain profitable. That's what's most important. The second strategy could be, I'm not sure what's going to happen, but maybe I'm investing in a 401k or 403b consistently. $1,000 goes in for 10 straight months. The third option is somebody who's nervous and they sit on the sidelines in cash with their $10,000 until the following January after the election is over. So let's compare what worked and what didn't. With the first scenario, the money that is invested in January stayed invested through the election year resulted in $15,860 on your $10,000 investment. Scenario number 2, where you're putting $1,000 a month for 10 months, did well, not quite as well, but pretty close, $15,765 on your $10,000 investment. And if you sat on the sidelines and you waited until after the election was over, then you put the money in, was the worst performance of those three scenarios, less than $15,000. It was $14,867. But let's look at the part of the chart where it looks at which ones were the best case scenarios compared to which ones were the worst case scenarios. Out of these 23 cycles, 20 of them were between either staying fully invested or investing over the time. So 20 of 23, you're better off staying invested and adding to your investments on a monthly basis. Only 3 out of 23 of the last elections did it become profitable, or the best possible scenario, I should say, to go to cash of any amount and wait for the election to go and complete before you put your money back in. What are the odds of getting it right sitting on the sidelines? Well, 3 out of 23. So if you want to go to cash and wait for the election, you've got a 3 out of 23 chance of that being the best possible outcome. I don't like that math. I think most people would agree with me. So in summary, as the data would suggest, the market performance is not directly tied to the election. The data would also suggest that you're better off keeping your money invested and adding to on a monthly basis if you're able to do so. In fact, only 2 times, 2 election years, has the market been negative going back to the 30s. Those years, the year 2000, coming off of a white-hot dot-com bubble bursting, and Enron and Tyco, if you remember those names, and 2008, when the housing bubble burst and we had the financial crisis. I think both of those events weren't directly tied to the presidency. They were just economic issues that we were facing at the time, so more of a coincidence than a presidential election outcome. All right. Switching gears slightly, let's talk about this webinar for young investors that we have coming up. I'm very excited about this. I love financial education. I wish it was a bigger requirement in schools, but I'll get off my soapbox for a second. So what the schools aren't doing is what we're attempting to kind of fill in the gap. So we're doing a free webinar. It's going to be March 14th at 6 p.m. via Zoom. So tune in wherever you are. Invite your nephews, your nieces, your kids, your neighbors' kids, whoever you want to have access to this free financial information. It's going to be a great resource. It's all of the different topics that we wish we were taught as kids, and now we've got the opportunity to hopefully share those with younger generations. Here's the topics that we're going to cover. In no particular order, we're going to talk about budgeting. How far will your dollars actually go, and how do you create a budget for a successful financial future? Debt and credit cards, the pitfalls and what to avoid with those, and how we look at maybe a repayment plan. We're going to talk about investing 101. We're going to keep it basic, and the most important point I want to make when we're talking about investing is time in the market and the power of compounding. I've got a really interesting chart, or at least I think so, but I'm a financial advisor, so I'm biased, that shows just how important it is to start early and stay consistent. One of the other topics that we're going to cover is workplace retirement plans, traditional pre-tax IRA versus Roth, how to take advantage of a work plan, and really some of the things that we should be doing as we're just getting started in our careers. We'll also have Q&A, so bring any questions that you have. We'll get to as many as we can. Again, that's going to be March 14th at 6 p.m. Invitations to follow. And lastly, as we're still in the beginning part of this year, we've got 2 things that we want to talk about. Reviews is a great time to review now that the holidays are behind us and we could be a little bit more business focused. Great time for reviews. We're reaching out, and if we haven't reached out or gotten to you yet, please contact us. We would love to sit down and do a review. Even if nothing's changed, we try to do these at least once a year or as often as you would like to. And the last thing is taxes. What can we expect for taxes? So everybody's gotten 1099-Rs, and some of these other, W-2s have to go out by the end of January. A lot of folks right now are waiting or maybe just starting to get 1099s for non-retirement portfolios. Any LPL portfolios, we're really waiting for the investments companies to give us the data, the final tax numbers. We assemble it and then send it out. So you can expect 1099s in February, and just a handful of people might get them in the first part of March. They go out as quickly as they can. Contact us if you haven't gotten anything or you're not sure if you've gotten everything that you need. We're happy to work through those with you. That's what we're here for. So let us help you. Schedule the reviews. Keep an eye out for that webinar for young investors, and let us know if you have any tax questions. As always, thank you for watching.